Ever wish you'd bought Amazon or Netflix stock back when they were just starting out? I mean, we're talking serious potential for life-changing returns, right?
Absolutely.
Well, today we're going deep on insights from Wall Street veteran Mark Mahaney, author of Nothing But Net, to try and uncover the secrets to picking winning tech stocks.
Mahaney spent decades analyzing the tech sector, seen it all, companies skyrocketing, crashing, so he definitely brings a wealth of experience.
Exactly. And we even have excerpts from the Chinese translation of his book, Ook, which, by the way, means precise stock selections, so we're getting a global perspective, too.
Oh, very cool.
Our mission today is to break down Mahaney's key lessons, really get at what drives success in tech, maybe even spark some ideas for your own investment strategy.
Sounds like a plan.
Well, Mahaney doesn't really sugarcoat things. He starts his book with a healthy dose of reality. He states that if you invest in the stock market, you will lose money from time to time. He even argues you'll sometimes lose money even when you've picked great stocks. How can that be?
Well, he points out that stock picking isn't just about being a good fundamentalist, being able to accurately predict a company's revenue and profits.
Right.
It's also about being a good psychologist, understanding how the market is going to react to that information.
Okay.
Think about it. A company can post really strong earnings, but the stock might plummet if investors were expecting even better results, or if there are broader market anxieties at play.
Right, right. He uses the example of the COVID-19 crash in 2020 when, well, everyone panicked. Even companies like Amazon, Etsy, Netflix, and Shopify, which ultimately have performed very well, saw their stocks drop significantly.
Yeah, the COVID-19 crash is the perfect example of how psychological factors like fear and uncertainty can really overpower even rational analysis.
Yeah. And he goes on to point out that big market corrections can impact even the strongest companies, regardless of their performance, individually. He talks about the 2018 market correction driven by, trade war worries and concerns about slowing global growth. It knocked a third off Amazon's value.
Wow.
Despite the company's, still solid outlook.
It's easy to get swept up in the day-to-day fluctuations of the market, especially with the constant news and expert opinions.
Oh, yeah.
Mahaney stresses the importance of kind of having that long-term investment horizon and focusing on those fundamentals rather than getting caught up in the short-term noise.
That's a great point, yeah. So how does Mahaney suggest we identify those companies with strong long-term potential then, those companies that will actually generate those positive returns?
Well, he introduces this simple yet really powerful concept, the 20% revenue growth rule. He believes that companies that are consistently growing their revenue by more than 20%, those are the ones with a real shot at being big winners.
So basically he's saying consistent, high revenue growth, it's a key indicator of a company tapping into a large market opportunity,
Right.
having a strong value proposition, effectively executing their strategy.
Exactly. He even highlights how rare this kind of growth actually is, pointing out that only about 2% of the S&P 500 companies are able to pull this off consistently.
Wow. Okay, so high revenue growth is important, but what fuels this growth? Mahaney seems to be a huge believer in product innovation.
Absolutely. He brings up some compelling examples, like Amazon's foray into cloud computing with AWS,
Right.
Netflix's transition from DVDs to streaming, and Spotify's decision to add podcasts to its platform. Each one of these moves, game changers, not a simple tweak. These companies didn't just improve existing products, they reimagined their businesses, embraced innovation to drive growth.
Okay. But how can everyday investors like us spot this kind of game-changing innovation before it's, obvious?
Well, Mahaney suggests a few things. First, pay attention to the consumer experience.
Yeah.
What are people saying about the product? Are they genuinely excited about it? Second, look at how competitors are reacting. Are they scrambling to copy features or strategies? If so, that's often a sign that a company has really struck a nerve. They're onto something truly disruptive.
Like when Facebook started copying features from Snapchat, that was a pretty clear sign that Snapchat was onto something, even if Facebook was trying to downplay it.
Exactly. And don't forget about the management team. A management team with a proven track record of innovation, that's a huge plus. If they've done it before, they're much more likely to do it again.
So we've got rapid revenue growth, product innovation as key things to watch for. What else should we be keeping in mind when evaluating these potential tech investments?
Mahaney puts a huge emphasis on what he calls TAM, total addressable market.
Okay.
He's even coined a fun analogy. You want to look for companies that have the potential to pull a Google
Pull Google. I like that. What does that mean
Don't
exactly?
think about Google's dominance in search.
Hmm.
They went from a small startup to a global powerhouse by capturing a huge chunk of the online search market, which led to a massively successful advertising business.
Right.
Mahaney is basically saying you want to find companies targeting these massive markets where they have the potential to achieve significant growth by capturing a large share, just like Google did.
So I guess that means we should be looking for companies with a small share in a large TAM, right? Because that means they have the potential to grow exponentially.
You got it. Mahaney gives the example of Uber and Lyft.
Okay.
They didn't just create the ride-sharing market, they actually expanded the entire transportation market by making rides so much more convenient and accessible than, like, traditional taxis.
And he argues that Spotify could be doing the same thing, not only disrupting the music industry, but also, potentially taking on radio advertising. That's a massive market.
Yeah, Spotify's user base and their ability to, like, gather and analyze data could be very powerful in the advertising arena.
So it's about finding those companies with the potential to completely disrupt massive markets and, create something entirely new in the process.
Right. It's about thinking big, just like Google did with search. But Mahaney cautions against getting so caught up in the hype of these potentially massive markets that we forget about the consumer.
Right. That's a good point. At the end of the day, it's all about products and services that people love and rely on.
Right. Mahaney is a big advocate for paying attention to the consumer value proposition.
Right.
He points to companies like Amazon, which consistently prioritized the customer experience, even if it meant sacrificing short-term profits.
Right.
And it's clearly paid off. But he contrasts this with companies like eBay and Grubhub, who he argues, got too comfortable with their high profits and didn't innovate enough to keep up with changing customer expectations.
Yeah.
Which resulted in less stellar outcomes for investors.
It's interesting that he brings up these examples. It seems to suggest that a laser focus on profit maximization can sometimes come at the expense of innovation and ultimately long-term growth.
Right.
So maybe the lesson here is don't just chase profits. Chase the customer. Create a product or service that people genuinely value, and the profits will likely follow.
It's a timeless principle, and perhaps even more critical in tech, where customer preferences and behaviors can shift so rapidly.
Speaking of people, what about the people behind the scenes, the ones driving these innovative products and services, the management team? How much importance does Mahaney place on them?
He actually believes the quality of the management team is one of the most important factors to consider when you're evaluating a tech investment.
Okay. He recommends looking for founder-led companies where the founders are still actively involved, because that often suggests a deeper commitment to the company's mission and vision.
Right.
He also emphasizes the importance of visionary leadership and a customer-centric approach. He cites examples like, Mark Zuckerberg and his long-term ambitions for Facebook, Reed Hastings, who basically invented the concept of streaming with Netflix.
These are great examples of leaders who have not only built successful businesses, but also fundamentally changed entire industries.
And he makes a really interesting point about management teams that I hadn't really considered before. Unlike, with investment funds, where past performance is not a guarantee of future returns, he believes that past performance is a decent indicator of future success when it comes to management teams.
It makes sense. If a management team has a proven track record of innovating, executing their plans well, and creating value for shareholders, it stands to reason they have a higher probability of repeating that success.
So we've talked about revenue growth, product innovation, TAM, even the management team. What about valuation? How much emphasis does Mahaney place on that?
Well, it might surprise you to learn that Mahaney doesn't think valuation should be your primary consideration, at least not in the traditional sense.
Wait, really? How can you ignore valuation? It seems like one of the most important factors.
He argues that while high-growth tech stocks often appear expensive on the surface, especially when you're comparing them to companies in more mature industries,
Right.
their potential needs to be viewed on a growth-adjusted basis.
So a high price-to-earnings ratio, or PE ratio, might not be such a red flag if the company's earnings are projected to grow rapidly in the future.
Exactly. It's about considering the company's potential future earnings, not just their current earnings. He suggests factoring in things like, the growth rate of earnings, the quality of those earnings, and the potential for expanding profit margins in the future.
It sounds like he's suggesting that investors need to develop a more nuanced approach to valuation than just looking at the current PE ratio in isolation.
You're catching on.
Mm-hmm.
He actually states that in many cases, companies with high earnings growth and high earnings quality often justify their seemingly high PE ratios.
So he's not saying to completely ignore valuation, but rather to look at it through a different lens,
Right.
one that takes into account the company's future growth potential.
You got it. And here's where things get really interesting. Mahaney has this strategy he calls dislocated high-quality stocks, or DHQs, which he believes is one of the most lucrative approaches to tech investing.
DHQs, what are those?
He defines DHQs as companies that possess all those ingredients for success: high revenue growth, a large total addressable market, innovative products and services, a solid consumer value proposition, and a strong management team, but for whatever reason are currently undervalued by the market.
So it's about finding those hidden gems that everyone else is overlooking.
Precisely. They might be experiencing temporary setbacks, the market might be misinterpreting their situation, or maybe they're going through a short-term dip in profits, creating a buying opportunity for savvy investors who can see their long-term potential.
Mahaney says that every high-quality company experiences some kind of dislocation at some point.
Yeah, it makes sense. The stock market is inherently volatile. And even the most successful companies will go through periods where the market is like overly skeptical or fixated on, short-term problems. Sentiment can shift so quickly.
He gives the example of the ANE stocks, Facebook, Amazon, Netflix, and Google. They've all had their share of dislocations over the years.
And those who had the foresight and conviction to buy during those periods were handsomely rewarded when the market eventually recognized their true value.
So buying these DHQs makes sense, but how do you know when it's time to sell?
Mahaney has a pretty straightforward rule for that. Sell when you see a material deterioration in the fundamentals.
So you're talking about a significant slowdown in revenue growth, maybe dipping below that magic 20% threshold we were talking about earlier.
Right. If the fundamental drivers of the business start to weaken, it might be a sign that the company's long-term prospects are no longer as bright.
Makes sense. I appreciate that Mahaney is so open about sharing his own successes and failures. He readily admits that even he gets it wrong sometimes.
It's refreshing to see that kind of honesty and humility, especially from someone with his level of experience and success. It makes his insights even more valuable because it demonstrates that even the best investors aren't infallible.
He highlights some of his big wins, like his long-term buy calls on Netflix, Amazon, and Priceline, which is now Booking.com, all of which have turned into massive successes for investors who followed his advice.
Those are some impressive calls. He clearly has a knack for identifying companies with the potential to become those industry leaders.
But he also talks about his misjudgments, like giving Blue Apron a buy rating, which didn't exactly work out as planned.
It's a good reminder that even with careful analysis, there are always risks involved in investing.
Yeah. He even admits to misjudging Twitter and giving Google a sell call back in 2004. Can you imagine selling Google in 2004?
Wow.
What a mistake that would have been.
It's surprising to hear that even someone like Mahaney, with his deep understanding of the tech sector, missed the boat on Google's potential.
Right. It makes you wonder what blind spots we all might have as investors.
Perhaps it's a reminder that no one has a crystal ball. And the tech landscape can change so dramatically in such a short period.
And you know what else I find fascinating about Mahaney? The way he weaves in these, captivating anecdotes from his career. Like the time he was with Mark Cuban when Broadcast.com stock skyrocketed 249% on its IPO day. Talk about a wild ride.
The dot-com boom was an incredible time, full of both spectacular successes and failures.
He also talks about seeing Jeff Bezos and Amazon's CFO engaged in a foot race at, a Seattle investor dinner.
Wow.
You can't make this stuff up.
Those kinds of anecdotes provide a glimpse into the personalities and cultures of these companies, which you just wouldn't get from, a financial report.
It humanizes the whole experience. And he even shares stories about, phone calls with Peter Lynch, the legendary investor, about Groupon.
Wow, that's amazing.
It's like he's been in the room for some of the biggest moments in tech history.
Mahaney's clearly had a front row seat to the evolution of the tech industry. It's fascinating to hear his perspective on how things have changed over the years.
But even with all his experience, he acknowledges that there are still many uncertainties about the future of tech. He describes the internet as the biggest bull market of the last 25 years, but wonders what the next 25 will bring. Are we on the cusp of, even bigger opportunities, or are we approaching a turning point?
It's the question on everyone's mind, right? What's next for tech? And, perhaps even more importantly, where are the next great investment opportunities?
Well, speaking of the next big thing, I'm curious to hear Mahaney's take on some of the major tech trends that he's watching closely.
He's always been ahead of the curve, so I'm sure his insights on these emerging trends will be valuable.
He seems particularly interested in the rise of AI, artificial intelligence. He believes it has the potential to revolutionize industries like, healthcare, transportation, entertainment.
AI is definitely a game changer. It's already transforming the way we live and work, and its influence is only going to grow in the coming years.
And he also talks about the increasing importance of cloud computing, which he sees as a key driver of a lot of other tech trends, AI and the Internet of Things.
That's a great point. Cloud computing provides that, infrastructure and the scalability that these new technologies need to thrive.
And then there's virtual and augmented reality, VR and AR. He believes it could eventually become as ubiquitous as smartphones are today.
VR and AR offer the potential for those incredible immersive experiences. And while they haven't quite reached, mass adoption yet, it's pretty easy to imagine them becoming an integral part of our lives in the future.
AI, cloud computing, VR, AR, that's a lot to keep track of.
It is.
It can feel a bit overwhelming.
It can be a lot to take in, but it's also incredibly exciting. There's so much innovation happening in the tech sector, so many opportunities for growth and disruption.
So how do we as investors make sense of it all? How do we sort through the hype and identify the real opportunities?
Well, I think Mahaney's book gives us a great framework for approaching tech investing. He emphasizes the importance of understanding those fundamental drivers of success: revenue growth, product innovation, total addressable market, consumer value proposition, and the management team. Those are the key ingredients to look for, regardless of the specific trends or companies that pique your interest.
So we need to be informed, adaptable, and strategic in our approach.
Exactly. And never forget that investing, especially in tech, is inherently risky. There will be ups and downs, winners and losers. It's important to remember Mahaney's point. There will be blood. Even the best investors make mistakes.
Right. But that's all part of the process, isn't it?
Absolutely. It's all part of the journey. And the potential rewards can be extraordinary for those who can navigate the risks and seize the opportunities.
We've covered a lot of ground today. We delved into Mahaney's key insights for tech investing. We touched on the rise of the Chinese tech market, and we've even explored some of his, personal experiences and anecdotes. Where do we go from here?
Well, I think it'd be fascinating to dig deeper into some of the specific companies and trends that Mahaney discusses in his book.
That sounds like a great place to start.
For instance, he has some really insightful commentary on companies like Facebook, Amazon, and Google. And he also offers some interesting perspectives on emerging trends, like the evolution of e-commerce and the rise of social media as a marketing platform.
I'm definitely curious to hear more about his thoughts on those topics.
And I'm sure our listeners are eager to learn more as well. So why don't we take a short break and then come back with a deeper dive into some of the most intriguing companies and trends shaping the future of tech.
Sounds like a plan. Okay, so let's kind of shift gears a bit and explore some of Mahaney's specific insights into the companies and trends that are, really shaping the tech landscape. I'm especially curious to hear his perspective on the Chinese tech market, since we have excerpts from the Chinese translation of his book. He seems to suggest that China could become an even more dominant force in tech over the next 25 years. That's a pretty bold statement.
It is bold, but it's not without merit. He points out that China already has this massive and rapidly growing middle class,
right?
A really strong entrepreneurial culture, and a government that is actively promoting the growth of its technology sector. These are all factors that could definitely propel China to the forefront of global innovation.
He highlights companies like Alibaba and Tencent, which have already achieved massive scale and, global recognition. They're not just copying Western companies, they're innovating in their own right and creating entirely new business models.
Yeah, Alibaba, for instance, has built this e-commerce ecosystem that dwarfs anything we have here in the West.
It's true.
And Tencent's WeChat app has become a ubiquitous platform for communication, social networking, payments, even government services in China.
So what does this all mean for investors? Should we all be rushing to buy shares of Chinese tech companies?
Well, Mahaney doesn't necessarily advocate for that. He cautions that, investing in the Chinese tech market can be a bit tricky.
Right.
There are different regulations, cultural nuances, political considerations that Western investors need to be aware of.
He even suggests that investors need to look beyond, the headlines and really dig into the underlying fundamentals of these Chinese tech companies.
It's not enough to just get caught up in the hype.
Right.
Just like with any investment, you need to carefully assess that revenue growth, the profitability, market opportunity, and, the strength of the management team.
He also suggests paying close attention to the, political landscape and the potential impact of government policies on these companies. The Chinese government has a history of intervening in its economy. So it's important to, factor that into your analysis.
It's all about understanding the unique risks and opportunities that come with investing in a market that operates under a different set of rules.
So China's tech sector presents both exciting opportunities and some challenges for Western investors.
Exactly. Mahaney's advice seems to be, do your homework, be aware of the risks, and don't be afraid to diversify your portfolio geographically.
It's interesting to contrast his perspective on the Chinese tech market with his insights on some of the biggest tech companies here in the U.S. For example, what's his take on Amazon? He was a big believer in them, right?
He was. And his long-term buy call on Amazon turned out to be incredibly profitable for investors who followed his advice. He saw early on that Amazon wasn't just an online bookstore.
Right.
They were building an e-commerce empire.
But it wasn't always smooth sailing, was it? I seem to recall that he even kind of missed the boat on Amazon for several years, early in his career.
It's true. He admits that he underestimated Amazon's potential in those early days. It's hard to imagine now, but Amazon was a much smaller and less diversified company back then, and a lot of analysts were skeptical about their long-term prospects.
It's almost impossible to believe that now, considering how dominant Amazon has become. They seem to have their fingers in just about every pie imaginable. What was it about Amazon that initially caused him to hesitate?
I think he, like a lot of others at the time, questioned whether Amazon could maintain that growth trajectory and, eventually become profitable. They were plowing so much money back into the business, expanding into new categories, building out their infrastructure, experimenting with new technologies. It wasn't clear to everyone that this approach would actually pay off.
But Jeff Bezos clearly had a vision, and he executed it, brilliantly. It's a reminder that sometimes the biggest winners are the companies that are willing to play that long game and invest heavily in building for the future, even if it means sacrificing short-term profits.
And Mahaney, to his credit, eventually recognized the error of his ways. He saw that Amazon was building something truly special, something that had the potential to, disrupt retail, logistics, cloud computing, even entertainment.
Right.
And he became one of their biggest advocates on Wall Street.
He wasn't afraid to admit he was wrong and change his mind when he was presented with new evidence. It takes a certain level of intellectual honesty to do that, especially in a high-pressure environment like Wall Street where everyone's always trying to be right.
I think that willingness to learn from his mistakes and adapt his thinking is one of the things that has made him such a successful investor.
So Mahaney eventually got on board the Amazon train, and rode it all the way to the bank. What about some of the other big tech companies? What was his view on Google, for instance?
His track record with Google is actually pretty interesting. He was initially very skeptical of them, even going so far as to give them a sell rating back in 2004.
Can you believe that?
Yeah, selling Google in 2004.
It seems unfathomable now, considering how dominant Google has become in search, advertising, mobile operating systems, so many other areas. What was he thinking?
Well, he argued at the time that Yahoo, believe it or not, was a better bet.
Wow.
He thought that Yahoo had a stronger position in search and content, and he underestimated the power of Google's search algorithm and their ability to really monetize their massive user base.
Well, we all know how that turned out. Google completely blew past Yahoo and became one of the most valuable companies in the world.
It's a good reminder that even the smartest investors can get things wrong, especially in a fast-moving industry like tech, where that competitive landscape can shift so rapidly. Sometimes that, seemingly obvious winner isn't always the one that ends up on top.
I guess it's also a reminder that even the most successful companies aren't immune to disruption. Companies like Yahoo and Nokia, which were once considered invincible, were ultimately overtaken by more innovative and agile competitors.
Yeah. It's a cautionary tale for investors.
Yeah.
Never get complacent. Just because a company is successful today, doesn't mean they will be tomorrow. The tech landscape is constantly evolving, and the companies that can adapt and innovate are the ones that are going to thrive over the long run.
It sounds like one of the biggest challenges for tech investors is trying to anticipate these shifts in the competitive landscape and identify those companies that are best positioned to, really capitalize on these emerging trends.
Exactly. It's not just about understanding the current market dynamics.
Right.
It's about trying to envision what the market will look like 5, 10, even 20 years from now.
That's a tall order. It's like trying to predict the future. How does Mahaney approach this challenge?
Well, he emphasizes the importance of, staying informed about the latest technological advancements and really paying attention to the companies that are pushing those boundaries of innovation.
He also seems to place a lot of emphasis on identifying companies that are targeting these, large and growing markets.
Right.
He talks about the concept of total addressable market, TAM, which we discussed earlier. He believes that the companies that are, going after these massive markets have the potential to generate the biggest returns.
Yeah, he uses that analogy of pulling a Google, which we talked about earlier.
Right.
He's looking for those companies that have the potential to capture a significant share of a huge market, just like Google did with search and advertising.
So we need to be thinking big. We're not just looking for companies that can, incrementally improve existing products or services.
Right.
We're looking for companies that can create entirely new markets or fundamentally disrupt existing ones.
Right. We're looking for the companies that can pull a Google, as Mahaney puts it.
But it's not just about the size of the market, is it? The company also needs to have, a great product or service that people actually want.
Absolutely. Mahaney stresses the importance of that consumer value proposition. He believes that companies that create products and services that people love and rely on, those are the ones that will ultimately succeed.
He uses the example of Amazon, which has consistently prioritized the customer experience, even if it meant sacrificing short-term profits.
Right.
And that approach has clearly paid off for them.
It's a good reminder that, focusing on creating value for your customers is not only the right thing to do ethically, but it's also good business.
So we've got the market opportunity, we've got the consumer value proposition. What other factors does Mahaney consider when evaluating tech investments?
Well, he places a lot of emphasis on the quality of the management team. He believes that a strong management team, especially one that is led by the company's founders, is crucial for success in the tech industry.
He likes to see leaders who are visionary, passionate, and deeply committed to the company's mission. He points to examples like, Mark Zuckerberg at Facebook and Reed Hastings at Netflix, both of whom have built these incredibly successful companies.
He also looks for management teams that have a proven track record of execution. He believes that, past performance, particularly when it comes to management teams, is a decent indicator of future success.
So it's not enough to just have a great idea. You also need to have the right people in place to, execute that idea and turn it into a successful business.
Exactly. And that's especially true in the tech industry where things move so quickly and the competitive landscape is constantly shifting.
It's fascinating to hear Mahaney's perspective on these companies and these trends. He's clearly someone who has a deep understanding of the tech sector and, a real knack for identifying the companies that are poised for success.
He's also not afraid to share his mistakes and the lessons he's learned along the way, which makes his insights even more valuable.
He's certainly given me a lot to think about as I evaluate, my own investment strategy. I'm actually curious to hear more about some of the specific company anecdotes he shares in his book.
Me too.
Oh.
He's been in the room for some of the biggest moments in tech history.
Right.
And those stories offer this really unique glimpse into the personalities and those events that have shaped the industry.
Let's dive into some of those stories next. What really struck me about Nothing But Net, and something we haven't touched on much yet, is how Mahaney really emphasizes the human side of investing.
It's interesting, how he weaves those personal anecdotes throughout the book. It definitely makes the lessons more relatable and memorable.
Remember that story about him witnessing Jeff Bezos and Amazon's CFO in a foot race at, a Seattle investor dinner?
Oh, yeah.
It's not something you'd typically find in a, financial analysis report.
Right.
But it reviews a lot about the company's culture.
It speaks to a certain drive and competitiveness that likely contributed to Amazon's success. And the fact that he's so open about his own missteps, like that early sell call on Google, it makes him seem more, trustworthy and human.
Yeah.
He's not presenting himself as this all-knowing oracle, but as someone who's made mistakes and learned from them.
It makes you realize that even the most seasoned experts don't always get it right.
Exactly. And I think that's a really important message for investors, especially those who might be new to the game. It's easy to get caught up in the hype and think that investing is all about finding the next sure thing. But the reality is there's always an element of risk. And even the smartest investors get things wrong sometimes.
So what can we as listeners kind of take away from Mahaney's approach?
I think there are a few key lessons here. First, don't just focus on the numbers when you're researching companies. Dig deeper, read interviews, watch videos, try to get a sense of the people behind the scenes, Understanding the company's culture and the motivations of its leaders can be just as important as understanding its financials.
It's like the old saying, invest in people, not just companies.
Exactly. Second, don't be afraid to challenge assumptions and do your own research. Just because a famous investor, like Mahaney, recommends a stock doesn't mean it's right for you.
Right.
You need to develop your own investment philosophy and do the work to make sure that any investment you make aligns with your goals and risk tolerance.
It's about being, an independent thinker and not just like blindly following the herd.
Precisely. And finally, remember that investing, especially in the tech sector, is a long game. There will be volatility, there will be setbacks.
Right.
Don't panic and sell at the first sign of trouble. If you've done your research and you believe in the company's long-term potential, stay the course.
Easier said than done, of course, especially when the market is going haywire. But I think it's important to remember that, volatility is inherent in the tech sector. These companies are constantly innovating and disrupting, which inevitably leads to those ups and downs in their stock prices.
And as Mahaney reminds us, even those downs can create opportunities for savvy investors who are willing to be patient and ride out the storm. Remember those dislocated high-quality stocks or DHQs we were talking about?
Right.
Those temporary dips can be a chance to buy into great companies at a discount.
So to sum it all up, do your research, think long-term, and don't be afraid to go against the grain if you really believe in a company's potential.
Well said.
Yeah.
And remember, investing isn't just about making money. It's also about being a part of something bigger. About supporting the companies and the technologies that are shaping the future.
I like that perspective. It's about making informed decisions that align with your values and kind of contribute to the future that you want to see.
Exactly. And who knows, maybe you'll even discover the next Amazon or Netflix along the way.
That's the dream, isn't it? Well, thanks for joining me on this deep dive into Mark Mahaney's wisdom. It's given me a lot to think about, and I hope our listeners feel the same way.
It's been a pleasure sharing these insights with you. And to our listeners, happy investing.